When Woolworths jumped 4.9% on Tuesday, institutional buyers were not rewarding a supermarket, they were hedging a war. The ASX 200 rose 1.17%, 99 points, on a single Truth Social post from Donald Trump announcing he had called off a planned military strike on Iran at the request of Gulf leaders. Brent crude fell 2.4% to US $109.20 a barrel, and that single drop triggered a mechanical rotation. Consumer staples funds absorbed selling from cyclicals, and JP Morgan simultaneously upgraded Woolworths to overweight with a $37 price target, framing the stock as a defensive earnings anchor rather than a margin under pressure retailer. The capital movement was specific. Foreign institutional buying rotated from materials and technology into consumer staples and healthcare, with Woolworths, Kohl's, and CSL the primary destinations. What makes Tuesday's rally structurally unstable is the condition underneath it. Woolworths' third quarter update in late April showed fuel and logistics costs rising faster than sales growth, and management froze prices on 300 household staples from May 1, compressing Q4 margins. JP Morgan's $37 target rests on the assumption that oil's retreat holds, but Trump simultaneously warned military readiness remained on a moment's notice. The 20% of global oil supply flowing through the Strait of Hormuz has not reopened. A peace deal hope is not a peace deal, and the spread between those two conditions is where the next positioning shift will happen.
The same oil shock driving Woolworths' cost squeeze is the variable the Reserve Bank of Australia cannot model out. Minutes from the May meeting, released on Tuesday, confirmed the board considered hiking rates again before settling on a hold at 4.35%, and the language was stark. Assistant Governor Sarah Hunter warned that if inflation expectations become entrenched, the RBA may need to engineer a slowdown comparable to the early 1990s recession. That framing is not a routine central bank communication. It is a conditional threat against any market participant pricing in a rate cut cycle. Inflation is currently running at 4.6%, and the RBA's own forecasts see headline CPI peaking at 4.8% in the June quarter, directly because of oil. The AUD fell nearly half a cent against the USD after the minutes were released, as investors read the hold decision as temporary rather than structural. Fund managers buying defensives on Tuesday were, in effect, pricing a slowdown scenario, one where rate hikes weigh on consumer discretionary, squeeze property, and push unemployment from its current level toward the RBA's own 4.7% forecast for 2028. The property transmission is already visible. Westpac's consumer sentiment survey shows an 18-month low in the good time to buy metric and a 2% drop in house price expectations, led by Australians over 60. What the RBA's minutes leave unresolved is the sequence. Whether the next move is a hike or a hold depends entirely on whether Tuesday's oil retreat is a turning point or a negotiating pause. That same rate and inflation calculus is what makes Mineral Resources' Bald Hill restart the most consequential single piece of corporate news on Tuesday. Not because of Mineral Resources itself, but because of what the timing signals about where investors are starting to price the recovery cycle. Mineral Resources announced the Bald Hill lithium mine in Western Australia will begin ramp-up activity in late May, with first spodumene concentrate production from July and first shipment from the Port of Esperance in Q1 FY27. The mine had been in care and maintenance since November 2024 when lithium prices collapsed. Lithium carbonate is now CNY 191,500 per ton, up 61% year-to-date, and management said the recovery is significant and sustained. Mineral Resources shares rose 0.86% on Tuesday, despite the broader mining sector lagging the consumer staples rotation, which is itself a signal. The Bald Hill restart attracted a different buyer class, lithium-focused long funds adding back exposure rather than defensive rotators. Mineral Resources expects the restart to create 370 jobs and cost $20 million, with FY27 guidance on FOB costs and volumes due August 27. The conditional question the market has not yet priced is whether that July production timeline holds if the Iran deal collapses and oil spikes again, raising logistics and energy input costs for a mine that has been dormant for 6 months. If Brent crude retreats below US 100 on a confirmed deal, Bald Hill's cost structure becomes competitive and the August guidance becomes a re-rating event. If the strike resumes and Brent holds above US 110, the restart timeline shifts and the 61% lithium carbonate recovery faces a new test. The verification benchmark is the Port of Esperance's first shipment date. If that date holds into Q1 FY27, the lithium recovery thesis survives the oil shock. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.